Thank you everybody for joining us today on our presentation of our Middle District Multifamily Student Housing Class A acquisition. We have with us Brad Seidel from MTN Investment Group, and Beth and Viv as well from MTN, and then KPI Capital Partners, myself, George Fajardo, Vladi Klerman, and Jonathan Paz. And so right now what we're going to do is we're going to go through this latest acquisition as far as all the details regarding the underwriting, market research, and everything that goes along with that. So I think at this time what I'll do is I'm just going to hand it over to Brad, and let Brad take it away, and then we'll do a Q&A at the end.
Awesome. Yeah, thank you, George. Brad Seidel here. I'm so excited to be presenting this property in particular, because I know KPI's strict underwriting. You know, when you guys give the thumbs up, it means a lot. I'm happy to be here to get your guys' approval on this one and present it to everybody. Our team here at MTN, we're so excited about this one. This is one I'm going to show you. Really, a lot is through the pictures. None of these are doctored. This is a new property, 2022 build, commercial mixed use. But the big thing is this is what people have been waiting for, right? They've been waiting. They're holding their money for things to drop, things to go wrong. This is a forced sale. So this is a great opportunity that came to us through relationships within our team. And you just can't get this type of a deal. This is all off market, came to us. So without further ado, let's dive in. We've got our disclaimer just showing, hey, keep the lawyers happy. Please read it when you get some more time. So again, let's go big picture, right? Why we love this deal. So forced sale, when you've got an opportunity to pick up this through a family relationship, personal relationships that were involved, but it's really it was really the seller forced it through personal issues, needed this property sold. So what we're doing is we are acquiring this asset, and we're going to take his business plan. And the way it works is typically as a builder, the first year they built it, they fire sold the rents to get occupancy shown. As you see, it's 100% occupancy, which we love. And then the upside is all ours now, that we bring it from these low rents up to market. So you're going to see a cash flowing property with 8% cash on cash, and we're going to hammer in these market fundamentals. And I know that's why KPI likes this deal. It is so rock solid. And you're going to see 3 to 4, and we say that, but right now the new data that's coming in, it's significantly higher on the rent comps for us to push up to. So again, run into the highlights. So what mixed use is, we've got 6 commercial properties on here as well. They're all triple net, and they're all pre-leased, or they're all leased up. And we also have 4 kiosks. Like, consider them like food trucks that are in the center. And all these are actually amenities. We'll dive into them. There's the F45. That's a gym by Mark Wahlberg. There's a very famous local Athens chef opening up his second restaurant. It's been wildly popular. But all these are amenities that typically owners like ourselves and you coming into this would have to pay out. These are cash flowing, revenue generating amenities where people go to the coffee shop and the Vitality Bowl shop, and you name it. So there's a lot of drive and draw there. Again, Class A, you're going to see a 2022 build here. Like this property is absolutely gorgeous. It is. We got to host a meetup there not too long ago, and to see people's reactions from the pictures. And it's just cool when you see the pictures are real. Obviously, the location is excellent. Athens is growing like crazy. And again, Class A property, 100% occupancy. That's all the stuff that just checks all of our boxes. Over to what people really care about. Let's hit them first with the target IRR of 18%. That is wild for those that have not really. And what I say that is, with a Class A 2022 build, getting 18% is you're not going to see it. And that's really because of the from circumstances that we're picking this up. The cash on cash, we'll dive into that more of the schedule, but again, 8%, as I mentioned. And I like to talk through equity multiples. So you put in 100,000, you're going to get 110 back, and with a hold period of 5 years for this one. But again, we'll dive into all this a lot more. Property details. All right, so look at this thing. Does this not look like the campus? If I took away the TMD on the top, the Mill District, you might think like, oh, this might be, you know, University of Georgia here. This is the Mill District. You've got a pretty solid breakdown. This centerpiece here where my cursor's at, that's where those kiosks are.
We're protecting students, all students.
It is a great question. It is
about state law, which someone's into school policy, they are for the most part one and the same. James said Cecil.
I think sorry, someone's got a hot mic, or the question was, is it all students? It is right now, it's 50% students, 50% market, but everybody is paying per the bed. So whether they're a student or they're not, typically students are guarantored by their parents, which is, again, what a great risk mitigator that is. Especially with the median income of University of Georgia upwards around 140,000. And what you're going to see is why there's a real draw for not just students, but for people that are looking at the regular commercial multifamily space. Again, right here in the center are those kiosks. We've got our Nighthawks Lounge, you know, the F45 gym up here. And again, we'll talk through, you know, big picture where this is located. But again, it's just really getting a good picture of how this layout is and why we fell in love, and anyone that starts getting involved in this will too. Speaking of that, I'm going to step back for a second, because taking a look at these pictures, and I keep like saying how excited we are, right? Like, look at this place. You're talking 12-foot ceilings. You know, quartz countertop finishes, LPF flooring, but everything is done to such a high level here. Again, it being brand new, and that Class A. I'm just going to let the pictures speak, because they truly do.
Yeah, when you say it's Class A, I mean, it really is truly Class A with high-end finishes, especially when you're talking about student housing. I mean, this is a place where you know, any student would love to live, and you know, anybody in general for that matter.
I love it, George. It's so true. We got you know, what you have are the top of the line, right? And this is a big risk mitigator for us. We have the top students, or the top paying students. What that typically means it's a safety measure, really, that from our expertise. You know, I know Biff is on the call. He's our COO. He's been in student for over 20 years. He will tell you that these types of students they're not putting their head through the wall. You know, this place is too nice. The parents, you know, have that backing of the guarantor as if anything does go wrong as well. But this is drawing a different type of individual. All right, let's just call it that. The students
and also Brad. And on that, I'm sorry to interrupt, but in order to obtain these types of returns, typically a tremendous amount of capital expenditures are required in order to get it up to this standard. So right out of the gate, in order to get the returns that we are showing on this property, that's pretty unfounded. That's pretty atypical.
John, your music to my ears, man. That's so true. We call this a Class A with value add returns, and that is exactly what John's saying. This would be theoretically, we'd buy this piece of junk and we would hope to turn it into what you're seeing today after a year and a half of work and construction and holding your money. Meanwhile, this is working for you today. It's already completed. So again, another risk mitigator for us. Speaking of the exterior, it's just classic, the classic look, these large windows on it. You know, we spoke to the top down look to it. But it just fits the neighborhood too. You know, the neighborhood is this area, the Boulevard Historic District. They did a great job of making sure that everything here fits within the community. And
Brad, excuse me 1 second. Can we ask everyone, please, to mute yourselves, because we're hearing some background noise, and it's a little distracting. So if you could please just mute yourself. Thank you.
Yeah, thanks, George. All I was saying was it really does fit the neighborhood quite well. Down here, you're going to see one of the kiosks that we've, this one right now is turned into this awesome coffee shop. I've stopped there. I had a bunch of coffees there already. There's a froze stand, Dog Day Froze, where it's basically a frozen popsicle of wine, and the sororities just line up on game day. They are through the parking lot. So these are the things that are not, you wouldn't normally think add to a property, but because of the mixed use aspect, it's actually a huge driver now, where people from even outside of our complex are driving in to get the coffee from Sunroof Coffee, to go to F45, whatever. And it's actually a driving force. It's actually a great marketing piece for us. Yeah, we talked through the commercial spaces here.
And that's a good point that I wanna go back to, Brad, because because you're having people coming in that don't necessarily live on the property, but because they want to use as amenities, they want to go to the gym, they want to go to the coffee shop, they want to go to the yoga shop, they want to come visit their friends. It creates that buzz where basically people are wanting to come and live there eventually. If they're living somewhere else, especially if you're talking about college students, they're waiting for that next semester for the lease to be up and basically move into this property instead of wherever they're currently living. And I know that we're going to be talking about the leases coming up, but that's a huge factor. A huge attraction is having these revenue centers that are also basically marketing and attracting people onto the property.
Short term is a lot of money.
It's very unique, George, and you know what? It all adds into our. We have a very specific strategy at MTN that we're really focused on. It's well located, highly efficient. So we're not paying. Typically, you have to pay for these amenities. We're not just paying. We're actually making money off of them, and it's well located, which we'll dive into. But and this strategy, this will be our third within a year. And it is, and I'd love to dive into more of our other ones, but they're killing it every single time when we find properties like this. This strategy holds so well. Diving into the floor plans real quick, we've got, what I love is little things that people don't think about, and this is what I think keeps retention high. On our 2 beds, again, that can be student, can be outside student, but we're targeting that. But think about this. You're hosting, you have the half bath out in the open area. You don't have to go through a bedroom to get to the bath. Little things like that are game changing. They are, especially at this top level where this is what people are paying for. That extra half bath, it means a lot. Going towards the area map. So I mentioned this beautiful historic district, and there's going to be pictures on there next, but what you'll see too is how pedestrian is, one, to downtown, where the action's at. And what we like so much about this is when you are downtown and you're actually downtown, it's crazy there. It's a great time, but you're actually in the puke sometimes, it's tough parking your car, you're parking in a garage. This is walkable, but just outside of that, you do have that neighborhood feel. As you can see, the bike trail, there's a trail right down to it that they're making happen. It's a great little neighborhood that we're in this, what's called the halo of UGA. It's all within walking distance, but you're not in the streets, if you would, of downtown. So talking through Athens, for those who aren't aware, obviously home of University of Georgia. At this point, I know our COO went here. It's where, again, his connections that actually brought this property to us through the developer. But the big thing that I like to bring up on Athens is the Doug Flutie effect. And I think it's so interesting because it sounds make-believe, but really what it means is when a football team is performing well, enrollment continues to go up over 18%, and it remains that way for over almost a decade, 8 to 10 years. So just putting that aside, already a beautiful spot, lots going on outside of football. This is that boulevard, historic boulevard area that I was talking about. I mean, you've got the music, the live music, the shows. There are driving forces, and that's why I think what's so cool is that we're not all student. Even though they are paying by the bed, we have empty nesters because there's a lot going on here. This town is so vibrant with that younger energy that's there. It is a little cheaper, I think, and it drives retirees type of thing. But there's just so much going on, as you can see, arts, retail, the Chase Street Elementary School that is down the street from us is the best in the area. It is the best elementary school, the best one in the area. So sometimes people want to come in for the year and just while they're building their home or whatever, that option's there as well. Again, going to the school itself, right? This is a tier 1 market. When you talk to when you're looking at student housing, and we've been doing it for quite some time now, this is arguably a top 3 market in the country. And I don't think you could maybe argue top 5 at the worst, but this is one of the best universities to have for student housing. The enrollments are over 40,000. Again, we talked to that Doug Flutie effect, which sounds crazy, but put yourself as an 18-year-old. I want to go to where the tailgate's at. I want to be part of that world. And as an 18-year-old, I think that's just where the mindset is. You know, the growth that we're seeing in enrollment really does break this COVID idea of like, hey, people aren't going back to school. That has been proven incorrect. The enrollment's well over where it was pre-pandemic. The other thing, and is super important for everyone to understand, is this Hope Scholarship down here, the Hope Zell Scholarship. It's actually funded by the lottery in Georgia. But what that does, it actually indirectly subsidizes our housing. And what that means is your kid is going to school. You've been saving for their school their entire lives. Great. They get into University of Georgia. 99% are participating in this scholarship. That means this scholarship is 80 to sometimes 100% tuition paid for. So now you have this big pile of money. Your kid's getting free tuition because they stayed in state. And what are you going to do with this money? You put it into a safe, beautiful housing. And that is why the absorption rate of Class A in Athens is 100%. 100% there. So why our occupancy is currently 100%, but I truly believe that it is subsidized by this scholarship. It's not even a belief. It's being shown that this is where they're putting their money. It's not to tuition, it's to housing. There's other demand drivers here. Again, just great university. It continues to shock me as an Ohio boy. Learning more about University of Georgia, how good of a school it actually is. And that continues to drive it as the acceptance rate is down, I think right around 40, 30, high 30s. But there's just so much there that's driven by the school. And I think that's an important, that energy that's there that drives people to want to live there is through this university. So we were talking about comps, right? And we were talked about the 100% absorption. So what you'll see is 100% across the board here, 100, 100, 100. But the important piece is that they're like many universities, they're not developer friendly. This is not an area where they want the big money to come in and make these. That's not what they want. But the difficulty for them is that all the land that's left is historic. It's all in this historic area. There's these old homes and they can't be touched. You can't knock them over and build these multifamilies. So with that being said, there's very little if anything, in the pipeline coming in for the Class A that could pose anything on a supply demand risk for us. And then more importantly, what you'll see, and it really goes to our business plan. And the business plan is so elegant yet simple. All we're doing is we're taking this developer who forced the sale to us before he could bring the rents up. It's all our upside. We are actualizing this delta, and what you'll see, 560, this is Mathis. Mathis is our best comp. It is very similarly built with low amenities, commercial mixed use. Anyways, what you're seeing here is like huge delta, a huge opportunity that we are just so excited about that this is the linchpin. And what's great about this is we are now over 50% pre-leased for the next year at $423 above where we were last year is what we're hitting already, only at 50. And that will continue to go up. So it just goes to show that the proof is in the pudding. The business plan's already being implemented. There's no more guesswork. This is happening, but what's cool about this slide is showing you how high this delta really is, right? There's a huge amount of upside to this property.
And on that point, Brad,
the
fact that we already have a waiting list for, one second, George.
No, I was just gonna interject real quick. Just for those who may not necessarily completely understand, what Brad is basically saying is that right now, this property is being acquired at approximately about $500 below market rent values. So the
That's
value
what a
add,
delta.
this is what he explained earlier, that's what the delta is, meaning that the rents for next year are already, those units are already being rented out on an average of approximately an extra $400 above what they're being rented today. So the new people that have already pre-leased, have already signed the lease for next year, for the next fall semester, for the most part, are already paying $400 more per month than the people that are currently living there today. And that's happening without having to put a penny into the properties. Normally, and this is what he was alluding to earlier, normally when you talk about a value add, you're talking about having to go in and rehab the place or upgrade it or update it, do some renovations to it, what have you. And so that requires obviously an expenditure, what's called the capex, right? The capital expenditure, so money to rehab it. And we're not having to do that in this case. And just by simply renewing the leases without putting any money into it, they're already being leased for $400 above what they're currently rented for today. And as that continues to move forward, those rents will continue to gradually increase as we move forward, as there's less supply in the property as the units become closer to rented.
That's correct.
90%.
Yeah, that's correct. And in addition to that, one of the biggest issues when you have such steep deltas is retention of occupancy, right? So when you typically increase deltas over a threshold of around $250 from past rents to current rents, you do risk your occupancy drifting on the downward slope. And the fact that we do have as much already committed tenants, as many committed tenants as we currently have, with the delta being as severe as it is indicative of number one, the market, and number two, of the property itself. And the fact that there is a lot of interest around this property. There is a lot of interest around UGA as a university as well. So the fact that we aren't seeing even a small dip in the retention and of our occupancy is tremendous, and it's definitely something that shouldn't be discounted.
Yeah, you guys, you're saying it right. That's the truth. It really is. It's again, it's the proof of business. It's a proof of concept that's there. That's the point. Is when I look at risks and the risks that goes into a true value add, we've done it. Our company's done it where the pipes burst and things set you back and they go over budget. There's none of this risk, but you get the same returns as you would on a property that has to go through that process. And that's, I mean, that right there is, it's amazing. This is very unique. This is not something that you're going to find. Again, this is an off market through, again, we're going through this business plan, but the whole point is done through personal relationship where the seller needed to sell. They had to sell this year. And it's a family issue. So again, our plan is just to bring these rents up. We will stabilize the rents. I believe that this can go, we underwrite that it's going to take 3 years to get to our market rate. I believe that we can get over that, but it goes to the underwriting that we're going to increase, again, currently more than 400 below competition, that we have now met that. And now our pre-lease, this is complete. We are 100% from August, and we will sell after stabilization or refi. Again, we don't have a crystal ball on where rates are going to go, but man, it's the amount of value that is already today occurred through these pre-leases is astronomical and is really impressive. The point of everyone being on here, and it's such an important part of you, especially if you haven't done this before, is your due diligence. Like, this is your job. Once you wire, you kick back, the money comes in through the mailbox, and it continues until the sale. You really kick your feet up. But this is the time to do your due diligence. And I want to answer any and all questions. I truly want to get this conversation rolling. I won't run into the annual cash flow too much, but I would love to talk through it. The NOI here, the year-on-year delta that you're going to see of 29.3, we're already at 27.3 today. So, and again, we're at 51. The idea is to continue to go up. It's just showing that we're there, and it's this is not really a pro forma as much anymore as it is actual numbers, which it's got to be music to any investor's ears. Going through the sources and uses, we've got our senior note out of Atlanta, Stonehill, a group that we've done a lot of business with. Very good relationship with them. They've come in with 17.5, and you can see our equity raising. I'd love to dive in again. Any questions you have, let's dive in. I'm here to answer them. There truly is no bad questions and anyone that asks it, I give you such props when this Q&A starts because it's so nerve-wracking to be the first one. I hope we get a bunch after this. I think most people's favorite slide right here, return projections. So very important to note that we have acquired this property with the developers' rents still in there. The way student works is that we cannot push these rents that we have that we're showing that are inked by the parents. They cannot be actualized until the next academic year. So it's not until year 2 do we start seeing the true cash flow of this amazing property to the tune of year 3, 4, and 5 in double-digit cash-on-cash returns on a Class A property. It's but that's why you'll see the zero there. It's just our business plan cannot be implemented until August of next year. That's when you start to see it. That's where the traction, the rubber meets the road, if you would. But yeah, so you're throwing in 100. And that's our. You're going to get our return of 215,000. Back again for Class A. It's very impressive. The big part that our team and I think KPI also appreciates is the post acquisition. So when you're with us at MTN, we've done 13 full cycle deals. We know how to not just acquire but to operate, and then on the back end for the capital event, how to best do that and ensure that the whole cycle, your money is taken care of, because we've done it and we know what can go wrong and what can go right and what to prep for. And a lot of that is quarterly analysis and reports coming. So we've got a portal that we communicate through that you'll receive, updates. I love seeing what my money's doing. My money's in Athens. I told my parents and my family about this one because it's just so. It is the best risk adjusted returns that you'll find in the market. Period. Because it can't compete with this value add, the risk that's out there. You could get better returns, but for the risk that's there is no better return in the market, and I will happily stand by that. Again, we're talking to the post acquisition expectations. Communication is so important. You want to know what's going on with your money. The quarterly distributions that come out, again, you'll start seeing those as the new year comes on, as new academic year comes into play. A little bit about our team. So we do have over 200 million in assets under management, over 100 years of experience. At least I think it's 75, but closer to 100 than 75. And again, what's important is that 13. I think when I ask people, it doesn't have to be through us, but I think it's such an important question to ask, hey, if I'm going to invest in this sponsorship team, how many deals have they gone full cycle? Such an important question. And the other important question is, are we putting our money where our mouth is? Are we investing in our own product? Because you'd be surprised how many people do not invest in their own. They hope to roll in fees. That's not us. We are investing. We invest in our properties, and again, putting our money where our mouth is. And I think all these things are, again, I want to go back to thanking KPI. I know how strict and difficult it is to get on their radar. Thank you so much. I think you see what's out there, and I very much appreciate you guys for having me. We've got Katie Ray, Beth Underhill here. They're client relations. I'd love to talk to you, reach out. We also, if you pull your phone out, here's our QR code right here. Gets you to our Agora portal. But with that being said, I love, and again, so many props to whoever gives the first question. I respect you so much, but I would like to open it to Q&A.
So Nidia had a question. She was asking, what is the initial investment? What is the minimum investment to start with?
Great question. So the minimum investment is $100,000. That being said, it would have to go through KPI and really understanding where it's more of a conversation piece. But we've had people come in as low as 50,000 if there's a relationship there with you all. And so much of that. So I guess 50,000 would be the minimum for us.
Let me see. So Brad, I just want to go back and sort of clarify again, so to make sure that everybody fully understands when it comes to the dividend payouts. In reality, I know that in your graph there it said year two, but technically we're really talking about August of 2024. So we're not really talking about a full year. It was a year when it was I know you guys were working on this for the last several months. So now that we're into December, that time has been shortened. So really we're talking about 9 months approximately by the time January rolls around, where our investors will begin to see the dividend payouts, correct?
Yeah. So what you're going to see is once that comes, you'll start seeing again, that's where that NOI jump will be actualized at that time. There'll be a little bit of time after that for us to ensure that they go out. But yes, right around that time will be the first distributions.
And I know you guys have a lot of experience when it comes to student housing versus just standard multifamily. Can you kind of talk a little bit about the pros and cons of one versus the other? Why student housing, or why not? What do you like about it? So on and so forth.
Absolutely. So, we talked to that Hope Scholarship. Florida has the Sunshine Scholarship. A lot of states have these. Again, so the government subsidizing these students to go to school, to stay in state. These are state-funded programs. Again, being the Class A student. So I want to clarify, yes, Biff Ramsey, our COO, he's been a student for 20 years. He's been our cornerstone on this. You're talking 25,000 beds full cycle. It's over $1 billion in student that he's been working with. So with his knowledge base, we know to go towards, and our strategy is very specific for a reason, is Class A. It is well positioned, well located, so that you can walk. That's a huge portion. And the other is that we're low operational expenses. We do not have this. We don't have the huge pool with the liability. We don't have the shuttle where we have to bus kids back and forth. That maintenance cost really eats into everything. This is so efficient. And so when you talk to student, when you hit those three, and again, we've proven it through, we're also in Georgia College and State University, about 2 hours away from here. That is right now is excellent returns on we've seen better than pro forma. And then we've also have the Middle Tennessee State just south of Nashville. Again, it hits this priority once when we have it, the students, and we say Class A because these are better. They're better tenants. They're still students. They still do things wrong, but also the parents with this median income, they're the ones that are guarantoring these leases. That does not happen anywhere else in real estate. You do not have a guarantor for your leases. Definitely not ones that are high income, that have, that are at least, and again, with the median income of 140, you can assume that if they're going for the Class A, they're probably above that. They're not willing to risk their credit on not paying it. And you'll see that in our books and our delinquencies. They're wildly low. The efficiencies that come with this, and me, just so you guys know, I didn't really want to do student. It was because of Biff and his knowledge. I saw it as a risk. And as I was educated, I realized there's no better space to be in. We are so happy to have found a niche that is really hidden. I think a lot of people feel the same way, George. And I think that they see it as a risk, and as a whole, it might be, but not in the niche we found, not in our strategy. It's proven. And that's why we continue to hammer it home, because it is, our investors love it, and they're asking for more.
Yeah, and to that point, when it comes to student housing, I know you mentioned before, but I think it's worth clarifying or reiterating a little bit. You count it per bed, right? 108 beds. So in actuality, there's 94 doors, correct? But we're actually able to underwrite it based on 108 beds, essentially 108 different leases. And so can you speak a little bit to that, to to explain a little more so people can understand it?
Yeah, and that's a great point, Joe. It is student specific only. It is done by, and any student property, you will see it's done by bed. The leases and as you said, so those two beds that we talked to earlier with a 2.5, anyone that's coming in, whether it be a student, and so we can't clarify, and we can't say, hey, only students can live here. But if you, as an open market, want to pay for both beds, that's fine. But that is a student only. What that does, though, think about what that does to the margins, right? You've got all these two beds that were essentially double charging. How good are our margins looking? That's also why you're not going to see, and why I argue the best risk-adjusted returns in the market,
me
period.
llegaron, yo creo que me
You're
llegan
not going to
mañana,
see that elsewhere.
porque ellos
Because
los
you can't.
procesaron tarde.
Sí,
vino Javier.
All right, Gloria, can you please mute yourself?
I'm sorry.
Please? Sorry.
I'm
No
sorry.
problem.
I'm
That's
sorry.
okay.
It's all good.
Yeah, I mean, that's a great point. That really does maximize the margins, because again, it's basically, what, an extra 14 leases for the number of units that are there.
And you'll have turn. So what's called in July, as certain students leave that are not renewing, by the way, our renewals are very high on these. But when you do have the students that end up leaving, there is money that's, it's all budgeted and underwritten and expected. We have a very healthy underwriting for the turn. That's part of where that margin, we're not actualizing all of it, and but still it is a majority of it we do, and it goes to our investors, to our bottom line.
And you did mention that it's already 50% leased out for next year, correct?
Yes, just over.
So can you explain that a little bit? So that means that there's already 50% of the units are already signed leases, completely booked, unavailable, because they're already accounted for. Is that correct?
Yeah, that's right. And I mean, I love this because when you look at a place with 100% absorption, so yes, you can leave, and technically they would either pay, or what they are mandated to do is they have to go find somebody and bring them in. But when there's 100% absorption, which means there's no vacancy in Class A, these get filled. They get filled. And we know this from the others. We know this from talking to the owner of the Mathis, who's also our broker in this, that they get filled because there's nowhere to go. And so what this means is that these are contracts. These are contracts written. I will be here, and I paid for this, and they're happy and they're relieved to do it. So to put this in reference, already 50%, and we're not even the new year yet. We're not even January. This is for August of next year, and we're already, I think, 52 or 53%. It goes to show just so many things that we like about this. It just keeps stacking. But yeah, this is for me, it's a big risk mitigator. We have these coming in. Not only is it shown before, but it's also at that level that John was saying, at $413 above is what we're already getting. There's no guesswork anymore. It's in ink. It's actualized. So
That's right.
And correct me if I'm wrong, you normally don't see that in traditional multifamily, because at best you have 60 days, right, to notify the existing tenants whether or not they're going to renew, or they're going to be vacating the property. So then at that point, you're hoping that your marketing is already in place, and hopefully you can fill that unit quickly without any gaps in between tenants. But here, I mean, you're basically leased up pretty much a year in advance because of the student housing component of it. And as you said, I mean, that's a huge risk mitigator, because now you don't have to necessarily forecast. Like you said, it's no longer a pro forma. You're actually looking at actual numbers almost a year in advance or half a year in advance.
So Sebastian has a question. He wants to know what type of structure this is, whether this is a 506B, 506C structure. If it's 506B, are we taking on non-accredited investors? So I'm going to leave it up to you to explain that.
A great question. This is a 506C as in Charlie, so accredited only on this one. Yeah, that's how all of ours have been, accredited only.
So I noticed that Sebastian, he did walk away. So I'm going to leave that into the chat so we can read that.
Okay. Thank you, John. Thank you, Sebastian. Good question. Yeah, that's yep, accredited for this one. 506C is in Charlie.
Yeah. Now, can we talk a little bit about the management side of it? Because especially when you're talking about property this size and just multifamily in general, having the right management in place, it's huge. It could be the deciding factor whether or not you're going to hit your numbers, whether you're going to be able to execute your business plan and really maximize profits. So can you guys talk a little bit about that as well?
Yeah. So College Town Properties is in the box. They are currently the ones that are managing today and are managing and will stay in the box with us. We like them because one, they're out of Athens. They're a very large company. They do it all over the country, but they are based out of Athens. They're right down the road. So there's a lot of efficiencies with them being there. But two, they have the finger on their pulse in this town. So the owner lives in Athens as well. The way that we got this famous chef to come in, this local Athens chef to come in, the F-45, the how they're bringing in these commercial, and obviously it's 100% lease, so that also goes to show in the residential side they're very effective. But we're just very impressed by this group, and so there's also efficiencies in leaving them in with not having to move them. They're familiar, they're ready to go, they're already pre-leasing. All this stuff. There's no reason to move them, and
Right.
yeah, we feel lucky to have that already in place and to be able to hit the ground running with them.
If it isn't broken.
That's right. Preach it. If it's not broken, don't fix it.
Now, a question that we've actually had recently with other investors is, can you walk us through? Let's say, okay, someone wants to move forward. I know that you have Katie and Beth working with the investors as far as what does the process look like if someone wants to register and actually wants to participate. Can you kind of walk us through that process so that it's clear for everyone?
Yeah, absolutely. It's important that this process. One, scan this code right here today. This is going to get you to the portal. The portal for us, you open an account, you start an account. Katie or Beth will get a notification and will either reach out or help you to fill out the paperwork that's required, the first steps. And then it really goes into, and mind you, Katie and Beth can answer any and all questions as well. If you'd like to hop on a call during this process before you sign anything with any or the entire team, we welcome it, because this is the part of that. This is your due diligence period. It's so important. And we're so confident in this one, and all the ones that we pick. We love having the opportunity to showcase more about this one. But they can definitely answer those through email. But it's really doing it through this portal. The communications are done through the portal once you've invested. Agora portal is what it's called, and through Agora. And yeah, so it's going to be done that you'll start on this QR code, or you'll start by reaching out to either Katie or Beth here. Their emails are listed here. But it's really not as crazy difficult as I thought it would be way back when I wanted to invest in, and we've done a good job of, in my opinion, of streamlining this and making sure that it's easy. There's no reason it shouldn't be. But yes, it starts at the portal.
Now, Brad, once, just to explain for someone who may be the first time sort of endeavoring into multifamily syndications. Okay, let's say that once they go through the process, they register, they're onboarded, they wire the funds. Now, what is the actual position in the project as an investor? Are they a member of the LLC that owns? Are they a part owner? Like, can you describe that a little bit so people really understand?
Yeah.
What the position is in the investment? Because
that's a great question, George. Yeah. So you're an owner, and why this is so cool is I remember many years ago I invested in REITs because I wanted to be in real estate, but I didn't know which one I want to do a fund. But as an owner, so you invest, you're a limited partner, which means you are a partner, but you have limited liability, which means there's no, in your sense of legality wise, it's a great protection to have. But you are an actual owner. What that means as an owner that you don't get in a REIT is that you're going to be able to get this what's called a Schedule K1 for depreciation. This is the wealthy cheat code. This is something that I want to yell from the rooftop to all my friends and family, because this is how you save and actually keep the money that you make through. You're going to show this paper loss. So we are going to do what's called a cost segregation study after we buy this year. And for the year of 2023, we're going to show and just off of early estimates, a 4 million or greater depreciation on this asset that will be spread to all the ownership. So depending on how much you invest, you'll have a pro rata or an equal share of that ownership. And what that will be shown in your IRS form Schedule K1. And so you're going to show this paper loss, and it's going to go against any other passive income that you've had to, again, save more money and actually keep the money that you earned. So it's such a great benefit of being an owner. And honestly, for all the ones that I've invested in as an LP, going to there, knowing that I touch the bricks and I'm like, I own these, you are an owner. And it is cool having it as opposed to these REITs and other ways to invest where it's out there in the Twitterverse.
Right.
But
right, you're not investing into a blind fund, or you actually have
so the main
you know
difference,
the actual address, the brick and mortar.
So the main difference between a syndication, the main difference between a syndication and a REIT is your ownership. The ownership interest within a syndication is on the property specific. So you will be an active owner of the company. With REITs, you are a percentage owner of the corporate entity that controls the property, and it's over a blanket of property. So you could be a partial owner of many properties, but in all reality, an owner of none of them. You are have a partial stake in the entity that owns on blanket the property. So that is a major differentiator there. This is actual tangible ownership. And there are added tax benefits to being a tangible owner to a property, which Brad emphasized.
Yeah, and you said the phrase right up, Brad. It's the passive income aspect of it. You literally just sit back, you start collecting your dividends, and of course the tax benefit of being able to offset your passive income from the various deductions that you're able to apply as an owner.
Yeah, and that's not shown in the returns, right? Because that's going to be different for talking with your CPA. It's going to maximizing that to your best ability is an individual sport, if you would. But the 2.05 equity multiple, the 18% IRR, that is not accounted for on the money you're going to save on the depreciation. It's added on top of that, which is again why so many people find these types of investments so strong and so powerful, is that utilization of depreciation.
Now, here's a question, because someone else asked me a couple of days ago. Depending on the exit strategy, I know that there's an option to either sell or refinance. If the decision is made to refinance, will the investors have an option to remain in the deal as a potential legacy property, even after receiving their initial capital back at the point of refinance?
Yeah, absolutely. So what'll happen is we'll go through it, and anyone that wishes to be paid out will do so. We will have a new offering at that time, and then it'll be based on the amount of people that wanted to cash out and leave, and the amount of people that want to continue to cash flow with us. I think a big piece that speaks to this deal is because we want to own this and cash flow this forever, for generations. This will make my grandkids money. This is when I say this deal is the best, I want my family in it. This is generational hold for us. And we will, if at any time, if you want to, during the new every 5 years, I'm not sure how we'll do it exactly after the first 5, but yes, you'll have the option to be bought out. But if you'd like to cash flow with us, you can remain. Obviously we'll have a completely new set of offerings at that time, so I can't speak to exactly what that will look like yet, but yeah, just so you know where our heads are at, it's to hold this for generations.
Yeah,
and that structure is atypical. So when
it is atypical, this is the first one where we want to do that because this is this good.
Yeah, there is a disparity with about 95% of the syndications out there.
Mm-hmm.
Yeah, that's how you're creating that legacy wealth, like you said, for your grandkids and future generations. So that's amazing. So does anybody have any other questions? I feel like I've been taking up.
No, you did great, George. You did great
time from
question.
people, but
Sebastian, it's
don't
I don't know if you're back, but we are a 506C as in Charlie for accredited investors only. And that's because we've chosen to advertise this. And so when you advertise, it needs to go out to accredited only.
It doesn't change the returns. It doesn't change the meat and potatoes. It's all the only thing that determines the change is the advertisability and the types of investors we can attract for this type of project.
Precisely.
So yeah, I mean, unless anybody has any other questions, if anybody wants to maybe have a one-on-one with either Brad and the MTN team or KPI, obviously you can always reach out to us directly. Maybe if you want to set up a follow-up call, a one-on-one call, maybe you can put a message here in the message box, or reach out to us. Let's see, I have Corinne. Hi Corinne, how are you? Let's see, what is the time window for investing?
Great question. So we have this thing turns into a pumpkin on the 15th of December. What that means is we need to get the funds in by, what is that, Friday? The Friday before. That will be the 8th, I believe.
Yes, Friday, December 8th.
There you go.
Is the deadline to.
So there it is. It is coming, and and what I say whenever there's a quick turnaround, I like to remind people that, like, imagine a house is for sale on your block, and it's the good one. It's like a really good deal, and it's a good house. It's not going to be sitting around there for months. It's going to get picked up. So this is no different. We've got a lot of interest, understandably, and we've got to the 8th of December to get these in, and it is first come, first serve. So we're not holding spots for anybody. I know I talked to George and Vladi earlier about what's available left, but it's the soft commits are all there to close. It's just whether or not who's wiring, and so that's where we'll be at. I invite, and I'm excited for anyone to come join us. And really we love to showcase our team and our communication skills. We try to hit it all at MTN, and again, after 13 full cycles of doing this, you do kind of fine tune this to a point where we know how to do this the right way.
Yeah, and obviously, to be fair, this is something that has already been in the works for several months. And even though the people on this particular call may just not be joining us for the first time, we're literally basically at the finish line, right? I mean, we're just that's why there's only a few limited spots left, because there's only the minimum amount left to raise to get this across the finish line.
That's it. Yeah, come join us. This is again, I hope you all see what we see, and I'm so excited about this one, and again, that's why my money's in it. And yeah, thank you, KPI. Unless there's more, I'd love to answer more, or reaching out to myself, Katie, Beth, anyone on the team, George, Jonathan. All great stuff. Always great questions, you guys. I love working with you guys. You really do have a very thorough and great, well-rounded understanding of real estate. So again, I appreciate your invite today. It means a lot to us at MTN, and yeah, thank you. If there's any more questions, please reach out.
Yeah, and thank you.